This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Throughout 2025, the housing market was locked in place by what economists called the Great Rate Lock-in. With 80% of homeowners reporting mortgage rates below 6%, most refused to sell and give up their pandemic-era rates. Buyers couldn't afford high prices. Sellers wouldn't list because moving meant tripling their monthly payment. The result was a frozen market, not crashing, just stuck. Mortgage rates hit their lowest level in over 3 years. The 30-year fixed rate dropped to 5.86% according to Zillow, while Freddie Mac reported 6.01%. That's well below the 6.85% rate from a year ago. President Trump announced that Fannie Mae and Freddie Mac will purchase $200 billion in mortgage-backed securities to push rates even lower. But despite dramatically lower rates, the market remains sluggish. Existing home sales fell 8.4% in January to just 3.91 million, a 16-month low. National home prices grew just 0.9% annually in December, one of the softest rates since the post-Great Recession recovery. New listings rose just 3.2% year-over-year. Regional differences remain stark. The Midwest and Northeast show strength. New Jersey up 5.5%, Illinois up 5.4%. Meanwhile, Miami is sitting at nearly 10 months of housing supply, giving buyers room to negotiate. Homeowners are staying in their homes an average of 8.5 years, the longest tenure in at least 25 years. The housing market is entering the Great Housing Reset, a years-long period of gradual increases in home sales as affordability slowly improves. For the first time since the Great Recession, incomes are rising faster than home prices. The trend is stabilization, not collapse, but also not dramatic relief. If you're trying to buy, this is the most opportunity you've had in years. Mortgage rates around 5.86% paired with rising inventory mean you finally have negotiating power, especially in Sun Belt markets. If you have a rate above 7%, refinancing could save you hundreds per month. But if you're locked into a pandemic-era rate around 3%, moving still means doubling or tripling your monthly payment. First-time buyers still face challenges. Even with rates below 6%, home prices remain elevated. Many young families are delaying homeownership or choosing multi-generational living. If you're renting, expect rents to rise 2 to 3% by year-end, but affordability is improving to its best level in 5 years. The Federal Reserve meets March 17th and 18th. If they hold rates steady, mortgage rates should stay near current levels. Watch new listing data in markets like Florida, where seasonal inventory rises in spring. Trump's $200 billion mortgage purchase program could push rates down another 0.25% to 0.5% if implemented quickly. Congress is considering the Housing for the 21st Century Act to reduce regulatory barriers and increase supply. The housing market isn't frozen anymore, it's recalibrating. If rates stay stable and inventory keeps climbing, this could finally be the year the market thaws. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.